Hello, I'm Debbie Walter from Union Public Library, helping Erica Bell out tonight. Um, Erica runs great programs, and I'm really happy to be able to help her with them. If just a few really quick messages. If you live, work, or go to school in Union, you can get a library card. It's very easy. All you have to do is go to the library with a photo ID and a bill or something that shows your address, and you're in. I don't know how many of you have been to Stuyvesant Avenue, where we've now opened up for the main library at 1060 Stuyvesant. Hope you'll all go and visit us. It's so clean. You could just about eat off the floor, although why would you want to? And I talked about the newsletter. Next week, in the next few weeks, we're doing a program on Houdini. We're doing an interviewing program for job interviews, and we're doing the Patterson Silk Strike, in addition to financial programs, meditation, and yoga. So without more advertisements, I'd like to introduce Stan Bridgeforth, who has helped us many times before and is an excellent guide to financial matters, something I need help on. Stan, can you unmute yourself and join us?
Good evening, everyone. Great to be here. Thank you for having me. Did you have anything else you needed to cover, or?
It's all yours.
Okay, excellent. So once again, my name is Stanley Bridgeforth. I am a financial coach, and you guys are in for a journey with me this evening. So I first want to thank you for setting some time aside to be with me tonight. You could have been anywhere else, but you chose to be here, so I am thankful for that. And tonight we're going to talk about investing. It is a very hot topic overall, but especially now with a lot of things that are going on in the world. So give me a moment, I'll share my screen and we'll begin the presentation. I'm gonna ask that you guys be engaging. If you have any questions, feel free to put it in the chat. If I can answer them while we are going through, I will. If not, we'll definitely have some time at the end to answer some questions. And all right, so as mentioned, we are here to learn about investing. This is going to be an introduction to the world of investing. Just a disclaimer, this workshop is for educational purposes. I am not a financial advisor. The ideas and strategies should never be used without first assessing your own personal and financial situation or without consulting a financial professional. So what I do is I offer education and guidance, but for direct recommendations, you would want to either do your own research, which I recommend anyway, or talk to someone who is certified. Now, allow me to introduce myself. Once again, my name is Stan, and I am a financial coach. I've been investing now for just about 20 years. My first introduction to the world of investing was through my company's employee stock purchase plan, where I didn't know much about it. I just saw that it was a discount on stocks and said, hey, I have some extra bucks, let me put it in there and hopefully it'll grow. But it was investing blindly. Over the years, I've taken more of a liking to the world of finance and money in particular, and also understanding the advantages of investing, which I'll get into in a little bit. And I've gotten a lot more interested and studied a lot more in terms of its contents. And as a financial coach, it's very imperative that I stay on top of these things so that I can deliver the best and biggest value to my clients. So my purpose and my passion really is your financial progress. So no matter where we come from, most of us don't come from money, but we know that investing is a vehicle that can change the dynamic and the projection of our quality of life. So I'm here to try to facilitate that process, and hopefully we'll be able to leave a legacy of some type of financial wealth or financial success that we can pass down for generations to come. Now, this class is for you if you've heard about investing and don't know where to begin, you would like to build wealth, have always been curious about the stock market and how it works, you want to leave a legacy of generational wealth, or you want more information on how investing actually works as a whole. And of course, you may have your own reasons as to why you're interested in the stock market. But here are going to be some of the learning outcomes. Number one, I want to help you understand what the stock market is and how it works, the benefits and risks that are involved in investing. There are different types of investment options, which we'll go through. Investment strategy, as with anything, you need to have a plan and some type of structure, and that'll, impact your level of success. And finally, I don't just want to be here talking and giving out information. The point is to help you get in the game so that you can start acquiring and taking part in the benefits that go along with investing. Quick word of inspiration. It's not how much money you make, but how much money you keep, how hard it works for you, and how many generations you keep it for. I want you guys to read that again and really let those words sink in. And that is a quote from Robert Kiyosaki, who is also known as Rich Dad. Because investing is really about making your money work for you, and it has the possibility of being around for generations to come, which is also referred to as having old money. So real quick, the history of the stock market and where it all began. We've all heard of the word Wall Street. We've heard of the location in Lower Manhattan, but this is where it got its name from. Initially in that area, when America and Lower Manhattan was first colonized, they actually had a wall down there. And that wall was designed for a couple of reasons. Because of its proximity to the port, it was designed, the wall was built so that it would keep out outside invaders, which would have been, other countries who were competing for the land at the time, as well as the Native Americans who were the local inhabitants. So it was there to keep them out as well. But in the late 1700s, on that particular street, there was a small group of merchants that used to meet there. Now, there was a lot of trade that was going on at the time. So they would sell stock, meaning cattle, livestock. They would do a lot of trading with different textiles and teas and spices and things of that nature. But this particular small group of merchants would get together under what's called a buttonwood tree, and they would talk about how to buy and sell interest in each other's organizations or companies at the time. So as they would get together and buy and sell these different interests in their own companies, they eventually signed what was called the Buttonwood Tree Agreement, named after the tree they used to meet under. And eventually, years later, that became known as the New York Stock Exchange. And yes, Rich Dad, Poor Dad is an excellent book. I highly recommend anyone to pick that up if you haven't read it, as it really speaks to the heart of growth mindset, abundance mindset, and a lot of other gems in that book. So we're going to get into what the stock market is. As an example, we start with Me Incorporated. They're selling goods and services. Now, when it first begins, it's going to be a private company, which means it's funded by a close-knit group of friends and family who believe in Me Inc.'s vision for success. So those people are going to pool some money together and they're going to give Me Inc. the money so that it can operate and, grow the business. Now, the company is doing great at this point, but it's looking to expand. So in order to do so, it will need to have more money, also known as raising more capital. Now, because Me Inc. already asked their friends and family for money who are early investors in the venture, they don't want to go back and ask them for more money, right? You don't want to annoy your friends and family by saying, hey, can I have some more money that you may or may not have? So what is the solution? The solution is to go public. And what that means is Me Inc. is now going to offer shares, also known as part ownership in the company, to a global pool of investors. So now, instead of having close group of friends and family who are invested in the company, going public, you're now literally opening your organization or your company up to public funding so that you can now use the funds or capital from going public to expand and grow your corporation. Now, as an investor, you can now buy and sell shares, which is known as trading, or you can hold on to them and then at a later time, you can sell them when the value has increased. So a lot of people hear about IPOs, right? That is the initial public offering from when a company goes from private to public. And at that point, you can either sell the shares in the company or you can hold on to them if you continue to believe that the company is going to do well down the line, and you can capitalize off of that increase in value. Now I'm just going to talk a little bit about benefits and risks of investing. But before we do that, I see a question. How do you determine the cost of shares? Very good question. So when a company is looking to go from private to public, there's something called an underwriting process. And that's usually done traditionally, it's traditionally done through an investment bank. So Me Inc. would get in contact with, let's say, JP Morgan or another investment bank, let them know what they're thinking of doing. The investment bank will do what's called a valuation, where they determine, how much the company is worth. And through the underwriting process, there will be a determination of how many shares should be issued and what the price would be for those shares. And then subsequently, once it hits the market, based on what happens on the stock market going forward, will determine the price of those shares. But real quick on to that point, the company only makes money on the initial offering. So the moment it hits the stock market, the first round of shares that goes out, let's say they issue 1 million shares, they only collect the capital that one time, right? That's considered the primary market. The secondary market is where everyone else buys and sells those shares at a loss or a gain. And that money stays with the investors in the stock market itself. It doesn't go back to the company. They only get it on that one time. Whatever the underwriter from the investment bank says is the cost per share, that is the amount of money that they get that one time. Now, obviously, not obviously, but there's an opportunity for them to offer or issue more shares to the public if they needed to raise more money down the line. But initially, they only get it that one time when they issue the first round of shares. Now, to the benefits and risks, right? Because everything has a good and a bad side. So the two biggest benefits of investing in the stock market or investing overall is compound interest. And what that is your money making more money for you, right? It's almost like your money going out and creating children. That's more money coming back into the house, right? And the second biggest benefit is the fact that it's either a wealth builder or a wealth creator. The stock market is one of the biggest money printing machines in the country, if not the world. It prints money every single day. And when it does, We hear that the rich get richer. That's continuing to build wealth. Or you have a lot of new people that benefit and come into wealth as a wealth creator. So if you and I, as common folks who may or may not be millionaires yet, one of the best ways to get to that point is through investing into the stock market. Now, on the other end of that coin, we have a couple of risks, right? You can lose money by investing, right? But there's a lot of different strategies and ways of investing so that you minimize that risk. But it is a very real possibility that you can lose money. But it's not I would say, as big a concern as people make it when you invest the right way. And the biggest risk of all, in my opinion, and if it's worth anything, is doing nothing and staying the same, right? So right now we have the trending topic every single day that we're hearing lately is inflation, right? Inflation means that the value of your dollar is going down, right? And there's many different types of inflation. Right now, we're dealing a lot with consumer inflation, where the price of goods has increased, right? So something that used to cost $2 now might cost $4, right? The price has gone up. If you stay the same and not do anything with your money, that means it's losing value. So what you want to do is you want to start putting your money in investment vehicles that is either going to keep pace with inflation or outpace inflation, meaning the value of your dollar and the return that you get on your investments will be higher than the rate of inflation. So staying the same is actually more dangerous than most people understand. Another quote, and this is great, from Albert Einstein. Compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. Right? So we are consumers, and hopefully by the end of this call, we'll also be investors. But think about this quote for a moment, because there's some people who pay compound interest. An example of that would be a credit card. And there's people that earn compound interest, and those are the people that invest. All right, so everything should have a mindset, right? And I like to challenge people with this picture. Is this glass half empty or is it half full? Your answer will determine what type of mindset you have, right? Do you have a scarcity type of mindset where you think that there's a lack of, or there's not enough? Or do you have an abundance mindset where you understand that there's more than enough available for everyone? I hope that if you do happen to have a scarcity mindset, that you do some things to shift that and go towards the direction of abundance mindset, because there is more than enough for everyone. There's more money available through the stock market for all of us to take advantage of. All right, so when we start talking about investing options, we primarily talk about stocks, bonds, mutual funds, and ETFs. So I'm going to go over what some of these terms are so that you have a better understanding of them. And then as we start seeing things on programs or in newspapers, we can say, okay, you have a better handle on what's going on out there in the investing world. All right, so with stocks and bonds, a stock is a share of ownership in a single company. Sometimes they're also known as equity. So when you're watching, CNBC or Yahoo Finance, and people interchangeably use stock to represent the term, or you might hear them talk about equities. But essentially, when you buy ownership in a company, you're buying a share, which represents that ownership. Now, once upon a time, you would get an actual certificate that, and sometimes you can still request them, but once upon a time, you would get a stock certificate, which verified and validated the fact that you owned shares in that particular company. Now, stocks are purchased for a share price, right? So we spoke a little bit earlier about initial public offerings and where the initial price comes from, but they're purchased for a share price, which can range from single digits, which would be, on the lower end, to a couple $1,000s, depending on the company. Real quick with the share price doesn't always equate to the strength of the company, right? Just because you see a low share price doesn't mean it's a bad company. And just because you see a high share price doesn't mean that the company is the best in the world. But for the sake of this conversation, share prices are what you purchase the stock for. Now, bonds are a little different. Bonds are essentially a loan to a company or government entity, which agrees to pay you back in a certain number of years. And in the meantime, you get interest, right? So there's a lot of different types of bonds. You have corporate bonds, which are also issued to raise money. It's just another way that corporations raise money. And then you also have government bonds, which a lot of people are more familiar with. One example of that would be, for instance, there's a new library that's being built in Union. So if the township of Union doesn't have the money on hand to fund the building of this new library, they can issue a bond. And what that is people can invest by way of lending the township of Union money to build this fabulous new library that's coming. And as a result, the township of Union will pay you interest, depending on the term of the repayment terms, right? So if it's 5 years, you'll get X amount of interest for 5 years. If it's 10 years or longer, whatever the terms of the bond are, you will get, interest payments, usually twice a year for the length of that bond until it comes to maturity. When a bond comes to maturity, then you'll get the initial amount that you put back into your pocket. So an example, if you put up, $1,000 and it's 10% interest that you're going to get annually, you'll get 2 payments for the next, let's just say 10 years. It's just another way of generating passive income for yourself. And it's considered one of the safer options when it comes to investing because the government usually always pays its bills. Right. So bonds are issued by corporations and government entities, not by individuals.
So Stan?
Yes.
From a business perspective, LLCs can offer bonds? Or it has to be a corp?
It would have to be a C corporation.
Okay.
I haven't heard of LLCs don't have stocks for ownership, or LLCs don't have owners outside of the people pertained in the operating agreement.
Mm-hmm.
So I don't think they would be able to issue bonds.
Okay. Thank you.
The next couple of investment options are mutual funds and ETFs. So initially, when we were investing in companies, you can only buy shares, right? If I wanted to invest in Apple, I would have to buy individual shares in Apple. If I wanted Microsoft, individual shares there. IBM, individual shares in IBM, right? That was traditionally how investments went. But along the way, as just about everything evolves, mutual funds came along as another investment option. And what a mutual fund is essentially a mix of investments that are packaged together, almost like a basket of investments. right? And what they do is they allow investors to skip the work of picking individual companies to invest in via stocks and bonds. And instead, it allows you to now purchase a diverse collection in one transaction. The inherent diversification of mutual funds makes them generally less risky than individual stocks. So remember, going back, we spoke about one of the risks being loss of capital or loss of money. Through the process of diversification is how we start to begin to minimize that risk of loss of money. And mutual funds is an option available to do that. Now, if you don't know, mutual funds is also know, a lot of people have mutual funds through their employer for a retirement fund. 401k is a form of a mutual fund. A 403b is a form of a mutual fund. TSPs and pension plans usually invest in mutual funds. Okay. And then ETFs are like the son or daughter of mutual funds, where very similar to a mutual fund, an ETF holds many individual investments bundled together. One of the main differences is that these ETFs trade throughout the day, just like a stock, and are purchased for a share price. The ETF share price is often lower than the minimum investment requirement of a mutual fund, which makes ETFs a good option for new investors and small budgets. So to elaborate a little bit on that, ETFs, essentially what's happening is you have what's called a fund manager. Let's take me, for instance. If Stan is a fund manager and I'm going out to the public and I'm gonna get everybody on this call plus all your family members to give me $1,000, and I'm gonna pool all of that money together. Let's say we're able to collect $1 million. What I would do as the fund manager is take that $1 million and invest it in a bunch of different companies, right? I'll get a little bit of IBM, I'll get a little bit of Apple, I'll get some Amazon, some Tesla, and some other companies until the $1 million is filled up. The advantage is if a share within Amazon is $3,000 or Google is $1,500, as an individual investor, it's difficult for me to invest in that company because it's so expensive. But by pooling the money together through an ETF, that fund manager can now take that $1 million or more and invest in those companies, and we all pretty much are a part of that investment, but for a fraction of the price. And if anyone has a question on that, I can elaborate a little bit later. But it is definitely a great way to get exposure to some great companies and own part of great companies at a much lower rate. And then on the flip side, it also offers you the diversification, which is absolutely important when we talk about investing. Now, a lot of people misunderstand investing and trading, right? So when people get fearful of putting money into the stock market, most of the time they're thinking about trading. Now, day trading is where we buy and sell, AKA trade stocks in one day, right? So today was Wednesday, stock market is open from 9:30 to 4. If I buy Apple today and sell Apple today, that is a day trade. Swing trading is when we typically buy and sell a stock in less than a year, right? So it could be anywhere from a couple of days to up to a year, but it's still considered short term, right? Anything less than a year is considered short term in the stock market. But we're still trading, right? There's still higher risk associated with these types of activities because from one day to the next, the stock market moves up and down like a roller coaster. So trading is a lot more risky than what we're going to talk about next, which is long-term buying and holding, which is actually investing, right? When you start hearing analysts and a lot of fund managers and wealth managers, the primary focus of those conversations is around long-term investing, long-term buying and holding, also known as value investing. And great question. ETFs are available on the open market. So if you go through whatever broker you have, you can get and invest in an ETF. And I'll get into that a little bit later as well. But to understand the difference between investing and trading, so that when people say, hey, yeah, I invest in the market. Well, long-term buying and holding is a lot safer than day trading and swing trading. And the longer that your money is in the market, the lower the risk of the lower the risk of you actually losing money over time. Now, we're going to talk about investment strategies. Everybody should have a plan, no matter what you're involved in, whether it's investing, whether it's some goals that you have, that you want to achieve in your life, whether it's with your career. There's always a plan and a strategy that should be involved with that. So investing is no different. And there's gonna be 3 parts to your strategy, right? Number 1, we want to figure out your why. What is the goal for my investing? Is it retirement? Do I want to buy a house? Is it a college fund for a kid? Is it to leave a legacy of generational wealth? I want to pass this down, to family members or to my children. Whatever your goal is, that's the first step in the strategy process. Step 2 is how much time do I have? Meaning, when am I going to need access to those funds? So if it's retirement, based on how old you are now versus when you plan on retiring, is going to determine that time that you're going to need access to the money, also known as your time horizon. The technical term is time horizon, right? And that's based in years. If it's a college fund and you have a baby, well, you might not need access to those funds for 17, 18 years, depending on how old they are. But you want to put in perspective when you're going to need access to those funds in years. And then based on those 2 things, your goal and why you are investing and for what reason, and when you combine that with when you need access to the funds, it's going to determine your mix of investments, also known as your portfolio, right? Asset allocation. What types of things are you going to invest in is what makes up your portfolio. Now we start talking about different types of strategies, right? So one strategy is you can absolutely invest in an ETF, right? Because it's already a pre-made mix of companies. It's not expensive to invest in. That's one type of strategy. For retirement accounts like Roth IRAs and traditional IRAs, that's a different type of investment strategy where you're going to use that money for once you retire. But here are some other types of strategies that you can use to invest, right? If you are going to go the route of investing in individual companies, I always suggest that you add some diversification with it. So we're in the investing game to grow our money. And obviously, this is all going to depend on your risk tolerance, what you can afford to invest, and how skittish you are about potentially losing money. But one strategy is that you can invest in 2 individual tech companies, for example, Apple and Microsoft, and then 2 ETFs. One ETF might be the S&P 500 ETF, or the other one might be a total market index ETF. This way you get growth and you get diversification in the event that those two individual companies don't do as well as you had planned. Another way for us to get involved into the market is to dollar cost average. What that means is you're going to contribute every single month what you can to your investments. If that's $25 a month, 50, 100, 1,000, whatever, after you go over your budget and you figure out what you can actually contribute to make it grow and earn more for you, you're going to contribute that every single month. But you're going to automate it so that it automatically happens. And because we're doing it every single month, as it happens, the stock market goes up and down. So some months you'll pay more for something, some months you'll pay less. And as a result, there's an average price that you end up paying for those investments. And then finally, there's something called a target date fund. And what that does is it offers you diversification, very similar to a mutual fund or an ETF. But the added benefit of the target date fund is it automatically balances the types of investments you have as you get closer to needing access to your funds. So what does that mean? All right, let's say today, this is the year 2022. If I don't need access to my money for another 20 years, what that target date fund is going to put my money into investments that are aggressive early on and that are going to be more poised for growth. And they're going to put my money in the smaller percentage of my money is going to be in what's called fixed income or bond type of things, right? Because you don't need a lot of bonds because you don't need access to the money, so you can afford to take a lot more risk in 2022. But as you get closer to 2042, that target date fund is automatically going to rebalance and shift the types of investments that you're involved in. So in 2040 or somewhere, in that ballpark, you're now going to have more bonds in your portfolio mix and less stock. The beauty of the target date fund is that it automatically does all of the work for you in terms of balancing out your investments and protecting you from any risk. Now, there's 3 different levels of investing. Level 1, which I highly recommend, if you are going to start investing, start with your employer's retirement plan. Or if you are a small business owner, you can create your own retirement plan. But you definitely want to get started by investing in your employer's retirement plan. And you want to inquire if they offer some type of match program. Now, what that is sometimes the employer will match you up to a certain percentage. If you put in 3%, if you put in 4%, they'll match that and they'll put in 3% or they'll put in 4%. So if that is a possibility for you, I definitely recommend taking advantage of that, especially because that match is you're leaving free money on the table. You're essentially doubling your investment. All right. And once again, a lot of employment retirement plans are 401ks, 403bs, TSP plans, pension plans, and things of that nature. The second level of investing that I recommend outside of your retirement plan, and some employers don't offer them, right? So it's to contribute the maximum you can to your IRA account. Now there's 2 types of IRAs. There's a traditional and there's a Roth IRA account. And basically it's an individual retirement account, meaning I, as an individual, as a regular person, is creating this account so that I can have something for myself when I decide to retire. Now, currently the maximum is $6,000 a year that you can contribute. And it changes based on the law. So level one, when we get in the game, we want to go through our employer's retirement plan. Number two, we want to max out our individual retirement account. And then step three is where you can now start being a lot more flexible with a regular brokerage account using a strategy of your choosing. That third one is after you have taken care of yourself in terms of your retirement account. And that's where you would do, if you want to do your target date fund, if you want to do your individual stocks, you heard about this from a friend, you want to do your research first. Step three is where you would get into that. So now that we've covered all of this information, what happens next, right? We know about how companies go public. We know about that process. We have an understanding of the different types of investments, stocks, bonds, and ETFs and mutual funds. We understand what goes into creating an effective strategy, and then what comes next. Well, the first thing you want to do is create a wish list, right? We want to see what types of things can we invest in. If it's individual stocks, what companies am I interested in? I usually recommend starting with what you know. What are some of your favorite stores that you like to shop at? What kind of phone do you have? What clothes do you wear? Most of the time, you'll be surprised that these are mostly publicly traded companies that you can invest in, right? So step one would be to create a wish list. And then not only are we looking at individual companies, but we'll be talking investing in ETFs as well, because we want to make sure we have diversification, right? Step two is we want to select a broker. Now, a broker is your gateway to the stock market, right? They are the middleman between you and the stock market. Now, there's lots of different types of brokers. And it depends on what type of person you are and what your needs are. If you are really heavily into research and you can do it all, a DIY type of person where you want to do it for yourself, then they have brokers available for that. If you like to do things on your own, but want somebody that you can, talk to from time to time, there's brokers for that. Then there's also full service brokers, which will offer the ability for a financial advisor to do everything for you, right? Sometimes they're also known as wealth managers. But you're definitely going to want to get a broker. And then finally, you want to put your toe in the water and invest, right? So this is the process. But before we're doing anything individually, I suggest we contact our employer to see if they offer any type of retirement plan. If the answer is yes, invest up to the match minimum. If the answer is no, then Roth or traditional IRA is available to you as setting up your own retirement option, right? Because we're thinking long term. And then after we have taken care of ourselves for the long term, then we can start to play around a lot more with these other investment options. Very good question. Someone asked, what about employee stock purchase plans? Are they safe? That was one of the first things I invested in, but like I said, I did it blindly. But the way an employee stock purchase plan works is you essentially are afforded the opportunity to invest in your company at a discounted price, right? So let's say, let's just use Nike as an example. The Nike stock might be $100 a share currently. As an employee, they say, you know what, we appreciate what you do for us. We're going to give you a 15% discount on that. So instead of paying $100 for the share, you're only paying $85 a share. So you're already winning because you bought those shares at a discount. Now, where does the wealth come in when it comes to buying individual shares? It comes from the number of shares that you own. So obviously 1 or 2 shares is not gonna do that for you. You wanna, and that's why automating is so important, because as we're investing automatically month in, month out, we're contributing, over time, that amount of money that we're contributing adds up, and the accumulation of shares is where the wealth is being built. And I always like to give some resources when I speak to people. I know I went over a lot of information relatively quickly, but here are some resources for you where you can follow up and get a proper understanding. Investopedia.com is a great resource for almost anything related, investment related. Good for understanding a lot of terms, a lot of investment expressions that you might hear. It's basically an encyclopedia for investing. Yahoo Finance is basically a financial website and also news channel that pretty much has information on what the market is doing today. So if you like to keep up with those things, but it's also an information resource where you can look up companies and different funds and see the performance there as well. And then finally, you heard me talk a lot about ETFs, and there's a lot of different funds, right? There's a fund for almost anything. There's funds based on industries, there's funds based on market sectors, there's potpourri funds that take a little bit from everywhere. But again, it's a mix of funds, a mix of companies that make up that fund that offers you diversification and exposure to those companies at a much lower rate. ETF database is an excellent resource to figure out what types of funds are available. And they do a great job of having different sorting features, which helps you with the research. So if you're into like now, what's trending is inclusion and diversity, equity, inclusion. If you want to invest in funds that only target companies that are in line with that, you can. Or you have ESG companies that are environmentally focused. If you want to know what types of funds invest in those, this this website will give you access to that information. But you are going to have to feel your way around, right? We have to be a lot more intentional and deliberate and start putting and setting aside time for things that are important and that are really going to benefit us. So you're going to have to put some skin in the game, right? You're going to have to start doing some research, whether that's daily, weekly, but you want to, schedule that into your activities to be able to say, you know what, I'm going to take my investment game to the next level, and I'm going to grab it by the horns, and I'm going to start doing a little bit of reading to have a better understanding of how this game is played, and then I'm going to play to win. And then we have a couple of books. Think and Grow Rich by Napoleon Hill is one of my favorites because it really talks about mindset, right? A lot of times we are unable to be successful because we're blocking our own blessings, so to speak, because we have the wrong type of thoughts and the wrong types of mentalities. But Think and Grow Rich is a book that is inspiring, motivating, and it helps to shift your mindset from scarcity to abundance. I Will Teach You to Be Rich is an excellent book And basically what he does is he takes you through 6 weeks of progression to investing into the stock market. And it's very detailed in terms of how to really do it the right way. And lastly, Money Master the Game is also another great resource in terms of providing information for people to learn about investing. Okay, and excuse me. So someone asked about cryptocurrency. I'll get to that in just a moment. Okay, so real quick, I want to thank you guys for, being with us this evening. I want to thank the Union Public Library for having me as a guest. Absolutely love being here with you guys. And, follow me on Instagram at stan.financialcoach. I normally do financial one-on-one coaching, but at the moment that is closed. But just be on the lookout for that when I open that up once again. And I know there's been some questions asked already, and I'm going to get to the cryptocurrency questions shortly. But any event that you were a little shy, or if something comes up afterwards that you didn't think of during the presentation, feel free to shoot me an email with any questions, or shoot me an email just to let me know, hey, Stan, I opened that account. I like to hear from you, if I've been able to help you, if I've been able to add value to you guys in any way. And I will now open the floor up for questions.
And I'm going to stop recording. And first, before I do that, I'm going to thank you and everybody else for being here tonight. I'll be more gracious in a minute.